Brad DeLong from Berkeley, very visible in the press recently, including Bloomberg View. Brad, what does the austerity crew most have wrong?
Well, what they most have wrong is their hope that if we cut federal spending, and right now, that something, either the foreign exchange market or the Federal Reserve, will save us. That deficit reduction leads to growth when it's accompanied either by a currency that declines in value and allows your exports to grow rapidly, or when it's accompanied by a central bank that is rolling out the money, and so goosing the economy just as federal spending drops off. And that's not what's going to happen.
Every time I see the word hope, I circle it. I think I learned that from Brad DeLong or Barry Eichengreen, one of the two. There's that political hope out there, and around it is theory. We had Michael Spence on yesterday on John Hicks. Here's what Brad DeLong wrote on the 72 laureate John Hicks. Bring this up here, folks. This is front and center in the debate right now as we get this up. The sorrow and pity of another liquidity trap. DeLong, Hicks's conclusion: as long as output remains depressed and there is slack in the economy, printing more bonds will have negligible effect in increasing interest rates. That's what we've seen so far, right, Brad?
That's exactly what we've seen so far. And back in 2008, I didn't believe it would happen. Right. Back in 2008, the fundamentalist Keynesians, Paul Krugman and company, were saying it's a time for Hicks, and that no matter how many bonds the Federal Reserve or the Treasury prints over the next 4 or 5 years, until the economy recovers, it won't have any effect on interest rates. Look at Japan's lost decade. And I didn't believe them, and I was wrong.
When you look, and you do state that, I really urge you folks to go to Brad DeLong's comments at his website and also at Bloomberg View, where he says, I was wrong. The debate is framed now is, okay, maybe Brad DeLong and Paul Krugman are right, but when interest rates go, they will go abruptly. Does history tell us that we get a jump condition in interest rates, or does it happen gradually?
Well, it happens gradually. It happens gradually as people get nervous, as people try to get themselves ready to undertake trading strategies by which they're going to be the first people out the door. And then after a long, gradual time during which the bond market deteriorates, then all of a sudden you have things like Italy in the past 4 days. In which the bond market simply collapses as people say, wait a minute, this economy has switched state, has switched from a situation in which the government is a sound and credible creditor to one in which the government is not. That's going to happen someday if our deficit continues at its current level, but there are no signs that someday is going to come in 2012 or 2013 or even 2014.
Rip up the script. We're going to digress right now. Brad DeLong, based on your study and teaching down the hall from Barry Eichengreen, should the Europe dissolve so those countries can devalue or depreciate their currencies and then restructure the euro after lessons learned?
I don't see how you can do it, and once it's dissolved, I don't see how you can reform it, because the fact that you dissolved it is the biggest possible signal that in the future you're going to dissolve it again, and that this is not really a currency union. If you do dissolve it, better to turn it into a two-tier system, an explicit two-tier system, or better to let the periphery float than to have them tied to the harder currencies. I don't see how that could be done.
Right.
Of course, I don't see how you can dissolve the euro either.
Okay, well, we'll leave it there. Some nice thoughts from Brad. Here's John Taylor across the bay. They're shooting darts at each other in the flight path of San Francisco Airport. On the 10th anniversary of the Keynesian revival, Paul Krugman, in a recent response to a John Taylor paper, says that he agrees with the paper that the stimulus didn't work, but argues that it just should have been larger. My rejoinder disputes that view. Brad DeLong, you clearly side with Krugman on this, but do we need QE3 after what we saw with the jobs report and after the challenges we have in Washington getting anything done in the deficit?
I think we need QE3. If Milton Friedman were here with us and if he was giving the same advice to the U.S. that he gave to Japan a decade ago, Milton Friedman would be saying that we need QE3. I don't see any argument against QE3. The worry is always that it will destabilize inflation expectations, that they'll lose their anchor. And yet, when you look out as far as you can at the prices of the tips and of the 30-year Treasury, you see no sign at all that there's been any loss of confidence that the Federal Reserve will keep inflation under control over the long run.
Well, Brad, do you pull housing into your aggregate analysis, or can we really keep it as a separate idea?
No, it's an important part of the aggregate. It's something that's putting substantial downward pressure on growth. Yet you have massive unemployment in the construction sector. You have lots of people who could easily be put to work in the construction sector, but they're not because of this housing overhang.
Here's the chart, folks. We go back to today's dollars, 173,000. We're just back to average. There's the leverage and the boom evaporating in a decade. Brad DeLong, how do we work out of our housing policy, whether it's Fannie Freddie or it's the foreclosures that you could probably see from Berkeley, California?
Well, the first the easiest answer is simply to say quantitative easing 3. Get more money, get more spending into the system, and all of a sudden you'll find that we don't have a housing surplus, we have a housing shortage. Think of it this way. During the boom, during the bubble, we built maybe 400 billion excess houses above trend. But since the crash, construction has been so depressed that we're now 1.5 trillion short of houses relative to the 1990 to 2003 trend. But even though we're short of houses relative to trend, we have an enormous excess supply of housing. Why? Because so many people have lost their jobs and are living in their brother's basements. And even if they've got a new job, they're not too eager to move out of their brother's basement for fear that they're going to lose it.
Bring up this
get our household formation back to where it ought to be, and we'll find the construction sector will cure itself.
It sounds like clear the market. Okay, let's get this op-ed up again. This is Bloomberg View. Interest rates paid by credit-worthy governments would remain low after a crisis. This formulation holds even in the face of enormous budget deficits that greatly expand the supply of government bonds. Well, certainly that's seen. Brad, I want you to speak to whether they're Republican or Democrats, those conservative, almost a Burkean conservative sense, the conservative part of the American public that they don't trust guys at Berkeley in tweed jackets. There's a distrust of letting the purse strings loose. How do you speak to that streak in America?
Well, you could say, suppose the government were running its affairs like a business that has been skimping on its own capital investment for the preceding 25 years for a whole bunch of reasons, and yet can borrow at absolutely unbelievable terms for the long run. If you're running a business and if the capital market comes to you and says, we're going to loan you money for the next 5 years at a negative real interest rate, you take the money. You take the money and you do something productive and useful with it. That's what capital markets are telling the U.S. government right now. People are saying that you are so creditworthy, that we trust you so much, that we're willing to lend you our money at a negative real interest rate for the next 5 years at a 2.93 nominal interest rate over the next 10 years in a world in which expected inflation is about 2.5%. Think of that. That's 43 basis points over 10 years. And you, the lender, bear all of the inflation risks associated with that.
Let's leave it there.
No private agent, no private business has ever been able to borrow on such terms. And if a private business could, its CEO and CFO would say now's the time to massively borrow, spend, and expand.
Let's leave it there.
Opportunities like this,
Brad, we're going to have to run. Brad DeLong, thank you so much from Berkeley. Folks.